morning, everyone, and welcome to the Estate Trust Tax Updates webinar presented by Hein & Associates. I'm Jennifer Nichols, your moderator and web organizer today. Before we start, let's take a moment to cover a few housekeeping items. All audio lines are muted. Please use our chat feature to ask questions. We will save time at the end for Q&A. This event is being recorded, and a link to the recording will be sent out to all registrants later today. Your active participation is important throughout the session. In order to receive CPE credits for this session, you will need to be connected for a minimum of 50 minutes and must answer 75% of the polling questions included throughout the presentation. Immediately following this webinar, you will be directed to a survey page where you can leave comments. Please check your inbox later today for a follow-up email that contains an evaluation form that must be submitted in order to receive your CPE certificate for the course, a link to the webinar recording, and presentation materials. Our presenter today is Myra, CPA, Partner, and National Director of Tax. Myra has over 30 years of professional experience providing tax planning and compliance services to both individuals and business organizations. Myra assists clients with significant transactions, corporate reorganizations, and specializes in partnerships, estates and trusts, and succession planning. Myra's expertise extends to highly specialized areas such as revenue recognition, capital formation, and mergers and acquisitions. Thank you for attending today, and I would now like to introduce Myra.
Thanks, Jen. Hey, I wanted to say thank you all for joining us on this session today. And if there are those on the line that know me, they will also know that I'll start going in different directions when we talk about different cases and different things that we'll address today. In particular, when I put this together, what I tried to do is to get a hodgepodge, if that's such a word, of the things that have happened in the estate and trust world for the latter part of 2016. So there's a lot of stuff here that deals with decanting rules, cases, some of the new regulations that are being proposed, and so that's what we're, in essence, going to go through. So the very first thing I want to talk about is something that you've probably seen a lot of information on, and it's Code Section 2704. And you're going, why, Myra, are you mentioning code sections all of a sudden? And the reason for that is because 2704 is the section that allows discounts to happen, valuation discounts to happen when there's transfers or gifts of closely held businesses. And as you know, these discounts have been for lack of marketability, lack of control, lack of liquidity, voting rights, non-transfer voting rights, etc. And so a lot of these cases in the past have allowed discounts. And now in my slide, I say the discounts could be 30% or more. In the past, discounts have ranged to as much as 64% in these cases. So what is 2704 doing now? Well, there's proposed regulations that are in existence and will be reviewed on December 1st that basically say all these cases that we've had in the past, which have gone on for years, are basically going to be invalid. And what these regulations do is eliminate most of the valuation discounts for transfers to family members, their entities, or their trusts. So again, it's an elimination of these discounts. So people who have formed, or families that have formed limited partnerships, transferred those limited partnership interests to members of their family and discounted them because the members of the family could not get control over the assets within the partnership, now potentially can still do the transfer, it's just it's now not going to be discounted. It applies to all business and investment companies and lost rights, including voting or liquidation rights. When you look at the regulations on this, they talk a lot about voting and liquidation rights. So this next slide I'll actually read because it's so very important. It says the Secretary may, by regulation, provide that restrictions shall be disregarded in determining the value of the transfer of any interest in both a corporation or partnership to a member of the transferor's family if such restriction has the effect of reducing the value of the transferred interest for purposes of 2704, but does not ultimately reduce the value of such interest to the transferee. So listen to what they said here. has the effect of reducing the value of the interest when it's transferred, but potentially does not ultimately reduce the value of such interest to the transferee. So that implies that that transferred interest stays in the family group and the family collectively has control over that interest. So other restrictions include a restriction on the ability to liquidate this interest as well. I mentioned earlier that there's a public hearing that is scheduled on these regulations on December 1st. And after the hearing, the IRS will begin analyzing changes and prepare for the final regulations. The effective date on this is effective upon publication of the final regulations. And yes, there will be court challenges. There will be court challenges that define restrictions, liquidations, whether this is valid, whether the transfers between closely held or closely held members' trusts are valid. And so there is an indication right now that it will be longer than the end of the year that these court challenges or that the regulations will be published. There's discussion on it now that basically says that there's changes that are already happening in definitions that are in the original proposed regulations. So what happens is these regulations change the playing field as it relates to selling or gifting equity ownership interests among family members. In essence, right now, potentially there's elimination of valuation discounts. So what happens if? Let's go through the what happens if questions. So let's say you have a co-tenancy. A co-tenancy ownership by each individual person is not subject to 2704 unless the co-tenancy is deemed a business entity. So even co-tenancies could qualify and eliminate valuation discounts. Transfers to grantor trusts or grantor retained annuity trusts of discounted assets for a note. Oftentimes transfers are made to trusts in exchange for a note. And then there are payments that are made out of the trust for that note. And so what's happened is after these are finalized, will undiscounted assets be used to avoid these? Will undiscounted assets be used in these transfers? And if they are, does that avoid gifts to trust beneficiary? So now you have to look at the consequences of action. Yes, you did a sale. Yes, the trust is making payment on the notes associated with it. If the payment is being made by assets, does that payment have to be with undiscounted assets to avoid any kind of gift tax effect to trust beneficiaries? This creates a huge problem in trying to define all of this. I actually added something else here, which basically is that 2704 treats certain lapses of voting and liquidation rights as deemed transfers if the family controls the entity both before and after the lapse of the right. There's an example in the regulations that talks about that a parent owns 84% and gives 42% equally to her 3 children. She no longer holds enough shares to force liquidation of the entity, but the lapsed liquidation right is not included because the rights associated with the transferred shares were not eliminated. So again, there's a huge amount of examples in the proposed regulations that talk about specific events that could create some issues. Now, what will happen on December 1st, 2016? Nobody knows. Will there be changes to the proposed regulations? Absolutely. The IRS has been trying to make changes to the discounts associated with transfers for a number of years, and so we'll see what happens as it moves further. There's a new 3-year rule that says if the donor dies within 3 years, the lapsed liquidation amount will be included in their gross estate, even though voting rights were not extinguished. And so this phantom value adds to the gross estate. That would not qualify for the marital deduction. So now you're looking at how does this affect that I've got a gift, but it's not deemed to be a gift. How does it affect the estate when the donor passes away? Example 4, the regulations. We talked about proposed regulations. Add a sentence that said if a parent dies within 3 years, the transfers would be treated as a lapse of the parent's liquidation right occurring at their death. If the liquidation right was valued or was taxed in the original transfer because of these disregarded regulations or restrictions, how do I avoid double taxations because of the estate tax at the back end? The mechanics on all of this are extraordinarily unclear, and some of the regulations try to address this in their examples, but they just don't necessarily come that far. What I did find out is from a national meeting of tax and estate planners where they got a representation from an IRS individual that any transfer, and this just happened recently, it was right at the end of October, that said any transfer made before the 2704 regulations are final will not be subject to look back, which is good. So this means that any transfers, gifts, or sales to family members or trusts for them before December 31st using discounted values, even if the transferring person dies within 3 years following that, then the new 2704 regulations will not apply. Another thing is there is some really good material out there on 2704. And what I'm going to talk about briefly right now is actually from Bessemer. Bessemer released a white paper on the Section 2704 proposed regulations, and they issued it in August of 2016. And in it, what they said is the types of entities subject to 2704 are described very broadly to include any entity or arrangement that is a business entity within the meaning of 7701, which is corporations, partnerships, etc., that is controlled by a family, and a definition of control is provided. In particular, LLCs are treated regardless of whether they're disregarded for federal tax purposes or not. So disregarded LLCs could also come within these rules. So if you get a chance, and I think it's available, go ahead and look if you can find the Bessemer Trust August 2016 proposed regulations that talk about the far-reaching, as they describe it, limitations on valuation discounts for transfers of interest to family-controlled entities.
Okay, so our first polling question. Consider looking at blank before the end of the year since Section 2704 is changing the playing field.
Okay. Terrific. So what I was looking at on this one is really, if we know we've got to the end of the year, basically, maybe beyond, but at least maybe we've got to the end of the year, maybe for your closely held businesses is you look at doing transfers of partnership interests or other interests to family members before the end of the year, knowing there's not going to be a look-back period. One of the concerns is really also look at any of your trust agreements or any of the agreements that you may have in place that allow for transfers. So I basically on this one, it was consider looking at transfers before the end of the year since 2704 is changing the playing field. Although I must admit I like some of these answers because Bessemer Trust, you were actually listening, that's awesome. Entities, so transferring entities would be great. Look at statute and regulations. As the regulations change, absolutely. Valuations, yes, I think the valuation people will be very busy between now and the end of the year, a lot like they were busy in 2010 when the belief was that the estate tax would have gone, or the unified credit would have gone up. And doing a transfer, absolutely, or gifting family interests. So I think that those were all good answers, actually, so thank you for that. So the next thing I'd like to talk about are grantor retained or charitable remainder annuity trusts and charitable remainder unit trusts. And the reason I want to talk about this is a unit trust, as you know, is a fixed percentage of the value of the assets. You know, so a unit trust has to pay out a fixed percentage of the value of the assets. And an annuity trust has to pay out a fixed amount of income. Now, there are what's known as exhaustion tests. And exhaustion tests on this is you can't pay out so that there's nothing left at the end. So there can be a no more than a 5% probability that the charity receives nothing. Because with an annuity trust, or remainder annuity trust and remainder unit trust, the charity is the remainder man in this case. They're the ones that get the remainder that's left in the trust. And so there has to be something left for the charity to get to get to make the rules work under these trusts. There's a new revenue procedure that is 2016-42 that addresses types of exhaustion. So it addresses what kind of rules you can come into place for charitable remainder annuity trusts. Also, charitable remainder unit trusts are more popular, amazingly enough, because they're not subject to the exhaustion rate. And the reason for that is because it's a fixed percentage of the value of the assets, so that it'll never hit exhaustion versus the fixed amount of income that is being paid. Next one. I want to address the new decanting rules that are in place in Colorado. I'm not sure if all of you that are attending right now have Colorado as your resident state, but I want to address that as well, is that the Colorado legislature enacted the Colorado Uniform Trust Decanting Act, effective in August of 16. And it allowed changes to be made to irrevocable trusts so that one trust could be poured into the other. That's decanting. And the reason they did that is it allowed them to change the situs, or governing instrument of the trust. It altered the trustee provisions. You could do that. You could alter powers of appointment. You could add special needs if it was necessary. And you could comply with tax law changes on this decanting. So you may want to consider, if you have clients that have an irrevocable trust, which they think needs some tweaking, is to look at some of, and they're in Colorado and other states that allow these decanting rules, is to know these rules have allowed much more flexibility in the ability to change a trust document. Obviously, you still have to go through the ways you have to make the changes from a legal perspective, but you have a lot more flexibility, and it's not just a Scrivener's error on that. So that's actually pretty good. The next thing, some of the hodgepodge of stuff I wanted to talk about that's come into play in 2016 is some of the cases that have happened toward the end of the year. One of those, and excuse my pronunciation as I go through the names of some of these cases, Goose Tina, I believe. And in this particular case, this actually had to do with valuation. And I still believe that valuation is an important consideration, at least now in the end of the year. And I honestly believe that when they actually make changes to some of the new rules or some of the proposed regulations, that it'll still be important. In this particular case, the tax court was doing a valuation of this entity. It was an entity that I believed owned timberland. And the tax court applied the discounted cash flow method, which basically to the operations, and the asset method as if the assets were sold. So it applied two methods in arriving at the value of the assets. The parties agreed on the valuation as it related to the discounted cash flow method, but then in addition, what the tax court did is they said there was a 25% probability that the company would be sold and the partnership liquidated. Therefore, they assigned a 75% discount to the discounted cash flow method and a 25% weight under the asset method. Then they applied a discount to the discounted cash flow method, but they didn't apply it to the asset method. And they said is that they believe that under the asset method, after the transfer, the interest would be sold. So basically, in this particular case, they used two methods, discounted cash flow and asset method, valuing assets, looking at discounted cash flow, applied a percentage to it, and then did a discount on one but not all. And then basically the Ninth Circuit came in on this one and reversed the case and held that the tax court erred in finding that there was a 25% chance that the partnership would dissolve, and in using the asset method to partially determine the value. They basically said in this case the buyer wouldn't be able to become a limited partner, remove the general partners, and convince the other partners to dissolve the partnership. As a result, the tax court revised the valuation to determine correctly under the discounted cash flow. So what does this tell us? It basically says, one, there's a number of ways that a valuation could be done with an entity. Two, at least at this point, they considered that you had to apply one method, the most viable method in making the valuation, and three, that in this particular case, a discount could be applied to it. So that's the case of Natalie B. Goose Tina. The next one I have is a private letter ruling, and it was issued at the end of the year, and it talked about a release of a general power of appointment over a trust. And basically, this was actually a really interesting one because there was a surviving spouse that entered into agreement with the children of her spouse, so the children of a first marriage of her spouse, in which they agreed to terminate a trust. And the decedent's revocable trust established the trust, and they made a Q-tip election, qualified terminal property election, on the decedent's estate return. Wife entered into an agreement with the kids and basically said the trust was to be terminated and the fixed amount of the trust assets was to be paid to the spouse, and then the trustee agreed to pay a percentage of the spouse's income and gift tax liability, which caused the termination of the trust. And the remaining assets in the trust were to be paid to the trust for the children. So in this case, there was actually an agreement between the spouse, the surviving spouse, and the children, and basically the surviving spouse did things to the decedent's trust that allowed items or assets to go to the surviving, or go to his children. But as part of this, the spouse released a general power of appointment over the trust. And the IRS, and they said, by the way, the IRS said everything else on this was good. But because she released a general power of appointment over the trust, the IRS ruled that a release of a general power of appointment was a taxable transfer and that she was making a gift of the value of the trust property at the time of release. And because she was making a gift and he wasn't, then his generation skipping election that was made on his estate return was invalid, and therefore it caused her to have a tax, a generation skipping tax, on her transfer. And so the point of this is, even if a lot of that relates to sort of some higher level stuff as it relates to generation skipping tax, the point of it was, watch the actions that you're doing. If there are actions that are causing things that is inconsistent with the original plan, really re-look at what those actions are and make sure that nothing affects, besides your trust liability, any kind of generation skipping tax or utilization of generation skipping tax. So that actually was fascinating because there's a lot that went into that. There's much more than I just talked about, but it was really fascinating. The next one I have is, and there's been a lot of on this year, which is, where does a trust live? And a trust lives where normally I always thought when I was in school that a trust lived is where the trustee lived or where the assets lived or where the beneficiaries were, and then you had to figure it out. Or the trust instrument said otherwise. So what you're looking at is that the trust place of residence is its situs or principal place of administration. This would seem to be where the administrative accounts are carried out, i.e. where the assets are, or where the trustee is, which in most cases is where the trust is, where it resides. But it could be where your capital gains are distributed or not distributed, and it really depends on a number of items. So there is a lot of cases that deal with where a trust lives, and if a trust was established by will, it's whether the testator resided in that state at his death. If the trust was established inter vivos instrument, whether the settlor resided in that state at the time of the trust was established or became irrevocable. But the one thing you really have to focus on is, do the state laws impose a settlor residence test? If they do, then the trust will be considered a resident of that state. So again, you have to look to state laws to determine if the trust imposes if the state imposes a settlor residence test. So what do you have to look at? Location of trust property, place of administration, where the trustee resides, where the beneficiaries reside, what state does the trust instrument indicate? Because the trust instrument could indicate one state, and the trustee could be another, the beneficiary is going to be in another, but the trust instrument may actually indicate a state. And then you have to look to whether you need to change that trust instrument, and how do you go about doing it. All of this, of course, is dependent on state laws. If the context of the state income tax law, the status of a non-grantor trust as a residence or not of a given state may have nothing to do with whether it is administered or whether the trustee resides. To assume otherwise would be a serious mistake. So again, as a trustee, you have to really look at where the trust is located, and you just cannot make assumptions because state law may dictate otherwise. We've got Nancy K. Duquette versus Dennis M. Moto. So in this particular case, this one we all have to pay attention to. In this one, we had Dennis. Dennis failed to pay his income taxes. So he failed to pay his federal income tax. By the way, Dennis was a doctor. So he failed to pay his income taxes. And this was a case that was in April this last year, or April of 2016. And but Dennis had a trust. And so the trust basically, he was a beneficiary of the trust, and the IRS was looking at trying to place a lien on Dennis's assets. And one of the assets that they looked at was the trust. This particular trust actually had ascertainable standards language, health, education, maintenance, welfare, which means it could pay out if Dennis needed the funds. And so what they did, the court in this particular case analyzed, it was Arizona. They analyzed Arizona state law and federal law in reaching their decision. And they first used state law to determine what rights Dennis had in the trust. And they categorized this trust as a discretionary support test, or a discretionary support trust, whereby the trustee may or must pay the beneficiary in accordance with his ascertainable standards. So they knew that payments had to go out to Dennis, but it was in accordance with his ascertainable standards, health, education, maintenance, welfare. Second, they used federal law to determine whether the taxpayer's state delineated rights qualified as property or rights to property under the federal law. The most important consideration in this and triggering this federal tax lien attachment is the breadth of control the taxpayer could exercise over his property. They then cited a U.S. case, which is United States versus Taylor, which basically highlighted several factors to suggest control by Dennis in this particular case. The court stated that the use of the words shall pay were significant, and they suggested it was within the trustee's discretion only how much to pay, not whether to pay. Further, this ascertainable standards language suggests that Dennis, the beneficiary, had a basic beneficial right to the trust funds for his living expenses. And in fact, the trust instrument said that if the trust assets fell below $10,000, they would just be distributed out to Dennis. So the IRS said, yes, they could place a lien on this trust. However, here's what they failed to do. They held that the IRS could attach the federal lien, but they stated that the attachment didn't qualify or justify enforcement of that lien as to a particular amount. The property rights had no fixed dollar amount and fluctuated according to the standards, needs, and living demands. And the IRS did not prove or provide any evidence of the beneficiary, Dennis's, needs or demands. And there was no reason to think that the lien extended to all of the trust funds. So the IRS had a valid lien against this trust, but couldn't enforce it without further evidence. It would be interesting to see what happened in the future with this trust as to whether it did pay out. And if it did pay out, Dennis's assets from that trust would have been attached by the IRS. In particular, I guess Dennis had substantial other means. So at this point, if there was no payout, the IRS couldn't get any funds. So next case we had is Holiday versus Commissioner. This one is had to do with a situation in which they did some estate planning for the mother. In this particular case, the mother, Sarah, had a business, and she established a limited partnership and funded it with marketable securities. She basically owned all of the LP interest, so the limited partnership interest. And then a limited liability company was a GP of this limited partnership. We've seen this a lot, where you have a 1% GP interest and a 0.1% GP interest and a 99.9% LP interest. At the day she formed the LP, the limited partnership, and the LLC, she also formed an irrevocable trust. And less than a week later, so within the same time period, she gave 10% of the limited partnership interest to an irrevocable trust and sold her interest to the LLC. Now remember, LLC was a general partner to her two sons. She retained substantial assets out of the limited partnership for her support. There were valid reasons actually to do this, and the IRS asserted that there were good reasons as to why they did this. But basically they said that the limited partnership interest was included in her estate upon her death. And what they said is that 2036 will apply if the decedent retains the right to income from transferred property, or there's an implied understanding that the decedent retained that right. Implied understanding that the decedent retained that right. In this case, her son sort of messed her up a bit on this, because based on the testimony from her sons, the court found that distributions would have been made to her out of these interests if she needed the funds. The court essentially disregarded the ownership of the general partnership interest by the LLC when it found that there was an understanding between Sarah and her sons that the LP, limited partnership interest, was available to her if she needed it. Now, one of the things that they talked about is to meet certain tests, there has to be a bona fide reason for a sale or a transfer. There must be significant non-tax reason for creating the limited partnership. The estate basically gave three reasons, which is protection from creditors, concern of undue influence from caretakers, and preservation of assets. By the way, we'll talk about caretakers in just a little bit because there's a lot of cases lately that talk about caretakers. The court found that the first two concerns were theoretical, but not in fact a concern. The court also found that the third claim unpersuasive because she, Sarah in this case, had retained other significant assets in her name. If she wanted preservation of assets in doing this transfer, she would have taken all of the assets that they had in her name and transferred it into some entity to avoid any concern with regard to creditors or preservation of assets. Perhaps most importantly is this. She didn't actively participate in the process, but merely went along with whatever her sons and the attorney decided. The court also noted that none of the partnership formalities were observed. There were no formal meetings held, no books kept, and no compensation paid. So what have we learned from this one? What we've learned is, and what we've always said in maintaining a legitimate partnership, is that you have to participate. You have to have valid assets. You have to have valid activities. You have to have participation. You have to have reasons for doing it. So that's what it's really, if you have a chance, that's actually a great case. And it's Holiday versus Commissioner. It was in March 17th of 2016. And it really sort of emphasizes a lot of things that you've talked about and probably worked with attorneys on, if not one yourself, dealing with how to do transfers into partnerships.
Okay, our next polling question. LLCs are often formed for protection from creditors. However, there must be a blank reason for forming an LLC.
You guys are good. Basically there has to be a legitimate non-tax reason for forming this LLC. So when it's done, just make sure that you have, like I said, a good partnership, a good LLC, a good limited partnership, that there's a reason for forming it, that all the events around it support it. Your answers are right on that one. So, not to say they wouldn't be right on, by the way. The next case that I have, and I know there was a problem hearing earlier. I hope I I hope that's been corrected and you can now hear me. If not, let us know. The next case is the estate of Victoria, yeah, you pronounce that, Derringer versus the commissioner. In this particular case, this was I love cases. You'll find I'm nerdy like that. So in this particular case, Victoria, in her estate plan, had bequeathed $600,000 to various charities of her estate, and the rest went to a family foundation. None of her children received any property under the estate plan other than personal property. None of her children. You think they were a little bit perturbed about this one? So what they had done to maybe get some additional funds from the foundation, they put a plan in place. And they discussed, after her death, so after Victoria's death in this particular case, the family and the company decided to convert this company from a C Corp to an S Corporation. There was legitimate reasons to do it. And then they decided to redeem the estate's shares. So the shares of this company held by the estate, they decided to redeem. These actions relieve the family foundation from having any problems with unrelated business taxable income or that type of thing. And then, so they had an appraisal at date of death, and then a second appraisal was obtained for purposes of this redemption. This second appraisal valued the shares using a discount of 15%, which they hadn't done before, or a discount of 15% for lack of control and marketability, which they hadn't done before. And in addition to the 5%, and then they also did a non-voting discount. The appraisal resulted in a substantially, like a 50% reduction in the value of the shares that were used in the redemption. So what happened is the foundation ended up with a note because the company redeemed the shares from the estate, which were going to the foundation, and this note was of a substantially reduced value because of the second appraisal. Well, that didn't work. The second appraisal was only 7 months after the appraisal of the estate tax return, and the reduced value of the shares was it depleted this value by 50%. And basically what they said is, sorry guys, we're not going to use date of death value for the shares that went to the foundation because of what happened in this very close time period after the death of Victoria. We're going to actually use this valuation that was used for the redemption. And so the charitable deduction that was shown on the estate tax return was discounted or reduced. And therefore then there was an estate tax. And as a result of this, there was an estate tax, and they also held or imposed an accuracy-related penalty because the estate was negligent in its instructions to the appraisers, didn't have a reasonable cause, and didn't act in good faith. So that one is facts create something. In this particular case, the appraisals that were done after death affected the estate tax return substantially. There were reasons they did it, or there were compelling non-tax reasons they did it, but it did affect the estate return. The assignment to assume any, this next one, Steinberg, the assignment to assume any potential estate tax liability should be considered in determining the fair market value of the gift, resulting in a reduction of the gift. In this one, the children, there was a transfer, an 89-year-old person who gifted her children $109 million in assets to her 4 children. The children assumed any kind of gift tax liability associated with the gift. This is often known as a net gift. And the children also assumed liability for any estate tax that would arise if the donor had died within 3 years of the date of the gift. They filed a timely gift tax return, valued the net gift. Under the 7520 tables, 7520 tables are their mortality tables. The IRS came back in and they said, sorry, you can't value it under this because she's 89 years old. I mean, you know, you can't use a contingent liability in doing a valuation of this gift. And basically the tax court rejected this argument and explained that the agreement was arm's length because at the time the children had no guarantee of being the remaining beneficiaries of the donor's estate. and she was still alive and could have changed her estate plan. So, and they also said that mortality tables for valuation purposes, IRS tried to argue those were inappropriate. That's incorrect. Basically, the court explained that the mortality tables, the 75-20 tables, are used to determine life expectancy of an individual who is not terminally ill. She was not terminally ill. The mortality tables necessarily take account of a person's health and general medical prognosis when arriving at a probability of death. So they said the mortality tables, even though she was 89 years old, were proper to use in this case. So again, transfers of a gift, transfer of assets of gift of an older person does not necessarily mean that you can't use the mortality tables in making that determination when they were doing a contingent liability. In the estate of Donald and Marion, in this particular case, the reason I bring this up is it dealt with a sale to a defective trust. As you know, a defective trust is one that is a grantor trust, but for estate tax purposes is taken out of the estate. It was an installment sale with a defined value clause, which has been allowed, allowing the number of shares to automatically adjust so that the fair market value of the stock purchased equaled the note amount, just in case there was problems with the valuation. Now, the IRS respects defective trusts if the grantor basically cedes it with assets that equal or exceed 10% of the fair value of the note. In this case, there was collateral was insurance policies. Also, the beneficiaries executed personal guarantees for 10% of the purchase price. The IRS ignored this note, saying it was a retained interest. They said there was a gift when the sale occurs, and they argued that the amount was included in the estate since the note was not debt, and therefore they argued beneficial enjoyment. Now, in this case, I don't know what the final result was because the parties settled this case without any tax liability. That's good for the taxpayer. So, but the point of this is, the takeaway on this piece of it is seeding a defective trust with certain types of assets. You should seed it with certain types of assets, cash and marketable securities. This is less likely to draw the IRS's attention. In this particular case, it was seeded with guarantees of a purchase price as well as with insurance policies. So again, in doing a defective trust, make sure it's seeded with common types of assets. The second thing is that the IRS did respect the defined value clause. And again, the defined value clause allowed the number of shares to automatically adjust so that the fair market value of the stock purchased equated or equaled the note amount. That's good. So it's showing more and more respect to having defined value clauses.
Okay, our next polling question. Blank clauses have been respected for estate gift tax purposes.
I gave you a giveaway on this one. Okay. I'm going to talk really close to this microphone here because it appears that there's having trouble with the sound today. But let us know, and I'll try and talk really loud, although you may not like it. Anyway, fiduciary, the next, that one, of course, was defined value clauses have been respected. Fiduciary law trends, honestly, as a trustee, you really have to be careful about being a fiduciary and make sure you have accurate reporting, periodic and accurate reporting. You have to review your documents. Now, all of this is pulled from cases that have happened this year. You have to review your documents to determine whether the credit shelter trusts and marital trusts will be properly funded and whether distribution provisions will apply. You have to review the funding and distribution provisions. And in that one case that we had with the ascertainable standards language, make sure you meet all the rules of the ascertainable standards language. We've talked about the modification, which is the new decanting rules that are in place. Some states don't allow for this. I've talked briefly about incapacity. There's a particular case in Redstone, and in Redstone, it's actually Sterling versus Sterling as well that dealt with the LA Clippers. In the Redstone case, it dealt with a gentleman who was the head of Viacom and CBS Corp, and basically he had thrown out of his house a friend, companion, and caretaker, was evicted from his mansion, and this caretaker subsequently filed for a petition for determination challenging this gentleman's, Redstone's, mental competence. He is now engaged and is still engaged in a battle regarding his mental health as it related to his caretaker, and he had given the caretaker certain powers within his documents. So again, watch caretakers. A lot of cases on this lately. Family law rules. There's virtual adoptions. Virtual adoptions are agreeing to adopt, but you fail to do so. So maybe you've agreed to adopt before death, and you've now failed to do so, and so that's been a lot of cases on that, technically arguing that somebody was adopted. You've got clients changing family situations, divorce, remarriage, new children. You've got adult adoption to gain access to trust. That's happening a lot lately, which is as an adult adoption to gain access, and investments and diversifications within a trust. So the fiduciary litigation that happened in 2016 saw a number of cases involving digital data, document execution, drafting errors, and other matters of composition within a trust. So as a fiduciary, if you are or maintain any kind of fiduciary capacity, you really have to be careful in looking at the desires of the original grantor of the trust, as well as any of the requests for what their intent was in forming the trust, whether it was to minimize taxes, whether it was to provide creditor issues, maybe providing an owner's counsel. There's a lot that's happening within the fiduciary tax world and some new changes on that, which has been fascinating. If you'd like to know information on that, let me know.
Okay, our fourth polling question. Make sure that the trustee and their advisors review the agreement to know the various blank that potentially could occur.
You know, that my answer to that originally was events that could occur, but I think I like some of your answers, though, when you talk about conflicts or problems that could occur within a trust. And so, again, review trust agreements, review what their content is, review through any changes, new decanting rules, take a look at that. Estate tax closing letters, it used to be you had to the IRS would issue closing letters automatically. They don't anymore because they were concerned about estate tax returns being filed just for the portability of the exemption being carried over to the surviving spouse. So now they will not issue closing letters. If you want it, you have to ask for it. So you actually call them to get that closing letter on an estate. I'm going to breeze through this next quickly, as there's a few other things I want to talk about. And this next one, ways that a trust can lose their SCorp status. If you're looking at a trust and a trust is an owner in an SCorp, they can be disqualified really quickly. And you could have trusts owned by more individuals. You could have foreign trusts or non-resident aliens, or you could have a non-resident alien and an electing small business trust election. The electing small business document may allow after-born children or grandchildren that may not be a U.S. citizen that could destroy the S corporation. Charitable remainder trusts, we talked about them, cannot be an eligible shareholder, although charities can. IRAs cannot be eligible if you have a defective trust provision. In this particular case, the grantor created a trust for the benefit of one beneficiary, but the trust was not eligible for the QSST election, the Qualified Subchapter S election, because it provided that if the trust property were included in the grantor's estate upon death, the trust assets could be used to pay a portion of the grantor's estate tax. Because of that provision, the grantor was a potential beneficiary, didn't meet the QSST test, and therefore became a disqualified S corporation. If you fail to do proper elections, if you do decanting, you have to do new elections for the electing small business trust. If you fail to make timely elections, when you do new changes, it's potentially an issue with an S corporation. So we have another polling question.
What is one way for an S corporation to inadvertently terminate?
Sorry that I ran through that last part very quickly, but you got the gist of it. What you really have to do as a both an S corp or if you're a trust that's a member of an S corp, is make sure that if you do anything in that trust, that you make sure the new elections are done, or you make sure that you have no clauses that could cause it to inadvertently terminate or become a disqualified shareholder of an S corp. Real quick, I just want to talk about there's some final regulations that define marriage that was issued in September 1st of 2016 that give new terms to husband, wife, and spouse. And there was a clarification of some of the rules on that followed federal rules. So again, just know that if you need definition of marriage, look to the Journal of Accountancy had a nice article of that was published in September of 2016. So now, what have we learned? What have we learned from all of this? Well, we have learned that 2704 is there. The question is how long it will be there, what will happen with it, what changes will occur. Will there be discounts, will they not? We know at least there's already been changes on it with regard to the 3-year rule. We've talked about exhaustion of trust. So make sure if you have a charitable remainder annuity trust that you meet the exhaustion rules, and there's a whole bunch of new rules that are associated with that. Decanting, yes, you could do it. Watch your state. Actions after and before transfers, any actions that occur after a transfer that potentially violate some of the terms of the transfer, we've seen that from cases, you've got to be careful about. State situs, yeah, that's a whole other thing. Look to state law. Access to assets of a trust, we talked about liens. Liens can be placed on trust, but not necessarily access to the assets. Other one, don't let your sons testify. That's it. You have to be really careful about what is said and the reasons for doing something. Mortality tables still work, even if you've got an older individual, as long as they're in good health. Defined value clauses still work, so that you equalize the value of the assets to the note that was received. Fiduciary responsibility, huge, and I'm sorry I ran through that so quickly, but that's a huge situation where you've got to make sure you understand the terms of your trust and meet what the grantor wanted or settler wanted, but still work with the beneficiaries in having a valid trust. Closing letters, remember to call. Remember to call on that. You don't get it otherwise. The last thing I have here is something that I had gotten from the U.S. It's a U.S. Trust Insights on Wealth and Worth. And I thought you would like this because, these days we always talk about as we move forward and in the generations that we work with in various ways, we talk about millennials. And I found this one fascinating, actually, because it says millennials establishing the blueprint for the future of wealth exhibit unique behaviors and values when it comes to money. The next generation is powering their optimism with alternative investment types, including asset classes that support positive social and environmental impact, as well as tangible assets such as commercial real estate, farmland, and timberland. And I found this fascinating, by the way, because a lot of the cases that I went through today involved farmland or timberland. So that's what I have.
Okay, we would now like to give our attendees a chance to ask questions. To ask a question, please submit a question via the chat box in the bottom left corner of your screen. If we don't get to your question during the webinar, our presenter will follow up with you via email. Okay, thank you, Myra, for your time today. That's all the time we have. Please check your inbox for a follow-up email with an evaluation form that must be submitted in order to receive your CPE certificate for the course. Thank you all again for attending, and have a great day.
Thank you.